All right. I'll be talking about the Fibonacci today on this video, how to use the Fibonacci to trade the market. Okay. The Fibonacci is not a strategy, it's just a tool, a simple tool, and this is what it looks like. Okay. It's just this tool. I want you to take note of the price level. You can just make a screenshot of this right now. These are the levels I use of the Fibonacci. I use the 0.382. I use the 0.5, 0.618, 0.786. I use the minus 0.272, and I use the minus 0.618 Fibonacci ratio. You can just take a screenshot of this so you can set the Fibonacci on your device like this, either on your phone or on your computer. All right. So this is what the tool look like. It's just a tool. I repeat, it's just a tool. It's not a strategy. It's a tool. It can help you with your analysis to actually understand how to be buying and where your target level should be and the rest. In the previous video, I talked about the trend. I said in the downtrend, the market keep making impulse correction, impulse. Usually after an impulse, there will always be a correction and another impulse, and the market can just keep doing this until there's likely a change of the move. Okay. This is in the case of a downtrend. In an uptrend, I said the same thing: an impulse, a correction, an impulse, a correction, another impulse, a correction, an impulse, and probably till the move changes in the market. What the Fibonacci would do for you is the Fibonacci would help you know how to calculate this impulse. This impulse you have right here, the Fibonacci will help you know where the correction is likely to get to before it made another impulse. So with the Fibonacci, if we have an impulse, for instance, you take your Fibonacci from the high to the low of the impulse. The correction can move to any of these Fibonacci level, and from that level you would know where you should make your entry and then where your profit target would be. So that's what I'll be showing you very quickly. So just take your time and pay attention to what I'm about to show you now. All right. So in a situation where we have a bearish impulse, where the market make a move to the downside, like remember, every impulse usually have a correction. All you need to do at this point is just to take your Fibonacci from the high of the impulse to the low. This is a bearish impulse. If it is in a case where it was a bullish impulse, I mean, where the market make a move to the upside, you take your Fibonacci from the low to the high of the impulse. Okay. But if it is a bearish impulse like what we have here, where the market came from the high to the low, you take your Fibonacci from the high to the low as well. What you are expecting is you're expecting a correction to any of these Fibonacci ratio level. The market could retrace at the 0.382 Fibonacci ratio. The market can retrace at this 0.5 Fibonacci ratio. The market can also retrace at the golden ratio, which is the 0.618 Fibonacci ratio. The market can also retrace at the 0.786 Fibonacci ratio. Now, but you can actually know where the market will retrace. Like we could have a case of a high tendency where the market is likely to retrace to. How you do that is when the Fibonacci aligned perfectly with structure. I'll be showing you what I mean by that. What I mean by aligned perfectly with structure is if any of this Fibonacci ratio level for the retracement or the impulse align with a support or resistant level, it will give you double confluence. What I mean is any of this Fibonacci ratio level align with confluence, which is structure level, support and resistance. You have double confluence. The retracement is likely to get to that level. I mean, this correction might likely, let's assume that the structure level, let's say the resistance level on the market is on the 61 point, the 0.61 is Fibonacci ratio. At this level, you would be expecting the market to make the next impulse to the downside. Okay, So it's going to be, you are expecting the market from that level to make the impulse. So you want to take your entry from that point, put your stop loss and put your take profit level where appropriate. All right. So I'm going to be taking that again. So, but I have just been able to establish the fact that the retracement could be on any of these levels, could be on the 0.382 Fibonacci ratio or the 0.5 or the 0.618 or the 0.786 Fibonacci ratio. So let's assume in this case, the market retraces to the 0.618 Fibonacci ratio. Don't forget, it can retrace to it can move to any of this level and then pull back from there. So, but for the case of an example, let's assume it went to the 0.618 Fibonacci ratio. And from this level, you notice it started creating another impulse, making another move to the downside. How do you know how do you know your take profit level for the next impulsive move? All you need to do is you just need to move your Fibonacci, move it to this, make this your next high. You want to know your profit, your take profit level. This is your first take profit and this is your second take profit, which is the 0.618 Fibonacci ratio. It is wrong, it's not correct if you decide that your take profit is just like this. If you decide to take your profit on this leg, just by leaving your Fibonacci like this, you decide to take a profit on this minus 0.272. If you decide to take a profit here, you are not correct, it's wrong. The right way to do it is, since the impulse has created itself, the correction is completed, you want to get the next move on the correction. You move your Fibonacci at the top of the correction. This will give you your take profit level. The take profit level is going to be the minus 0.272 Fibonacci ratio or the minus 0.618 Fibonacci ratio. Don't forget, it depends on which of them align perfectly with structure. Okay, so from here, your take profit is likely to be any of this level. Okay, when the market do this, from here you are expecting another correction because this is an impulse. This level has been broken. You are expecting another correction to take place. How then do you measure the next correction? Just like what I explained initially, you can decide to delete your Fibonacci, or perhaps you can just drag it to this level. Okay, if that is going to confuse you, you can delete it, take your Fibonacci again from this high to this low. All right, and from this level, we're expecting the market to, let's say the market goes up to 0.5 Fibonacci ratio level, and from here start another retracement downward. What you do, it's very simple. Move the Fibonacci to the retracement leg. That will give you the information on the next impulse where your take profit should be. So you're taking this trade and this is your take profit level on the minus 0.272 Fibonacci ratio, and your take profit 2 will be at the minus 0.618 Fibonacci ratio. That's how the Fibonacci works with the market. Okay, it's a very simple technique and there is actually nothing special to it. Okay, I've just shown you that example. On the same thing is applicable when you are trying to apply it on an upward move like this. All you need to do, since the market has given you a bullish impulse, to take your Fibonacci from the low to the high of the impulse. You're expecting a retracement to any of the Fibonacci ratio level, but if you can see the closest support, if the closest support align perfectly well with, let's say, 0.50 of the Fibonacci ratio, from here you're expecting the move to the upside. All you need to do is very simple. To get the next impulsive move, drag your Fibonacci to the retracement leg, which is the correction leg. You now know where your next take profit is here, take profit 1 and take profit 2, depending on the structure you can find. All right, so it's a very simple technique that you can use to trade the market. Now let's use it on the live chart. Let's use it on the live chart. Okay, right here we have a situation on, this is a live chart, and I think there's an opportunity to trade on this particular currency right now. This is Euro AUD, and you can see there is an impulsive move. You can see this move to the downside. And usually after an impulse, we usually have a correction. You can decide to want to measure the correction. Of course, you notice there was a correction. This is a correction upward. And as you can see, the market is trying to make another impulse. Probably it's going to be an impulse, but there is a new move to the downside, obviously. How do you handle this? You take your Fibonacci from the high of the impulse to the low of it. Okay. As you can see, the market retraced to the, you can let me use the box. You can see the market retraced to this level. And if you look closely, you discover it's aligned perfectly well with the previous structure area, which is what we have around here. As you can see, that the Fibonacci ratio level that align perfectly well is the 0.5 Fibonacci ratio level and the 0.618 Fibonacci ratio level. Okay, that is confluence. Okay, we've just met the confluence. You can see the Fibonacci align perfectly well with the structure level. At that point, we can see from this that since the correction has been completed, the market might likely make another impulse. So if we are to take this trade, how do we know our take profit level? It's very simple. All we need to do is take our Fibonacci. We'll take our Fibonacci. This was the move we had before, and it retraced to this. It retraced to this level. Retraced to this level. All we need to do now is to take our Fibonacci to the correction leg, because we want to get our take profit level. So our take profit level is going to be at the minus 0.272 Fibonacci ratio, and our take profit 2 will be at the minus 0.618 Fibonacci ratio. Okay, so we're expecting the move on this pair to come all the way down to this point. When it does this, it's also showing us something. It's also showing us the head and shoulder pattern, which is one of the stuff I'll be teaching you later. You can see left shoulder, head, and right shoulder. Okay, it's a very valid opportunity. I have a position open on it already. So that is how we use the Fibonacci. Okay, you will notice this work perfectly well. Let me give you one more example. From this same move the market make here, we can see, if you look carefully here, you will notice there is an impulse. There's an impulse to the upside. Okay, there was this move to the upside, and the moment you find this move, you want to know where you want to check the retracement. You would notice there is a support. There's a support level here. We have a support level here, very valid support level. And we're looking at checking out this move, this impulsive move to the upside. All you need to do is to take your Fibonacci from the low to the high of this impulsive move. As you can see, the correction went down to the 0.50, the 0.5 Fibonacci ratio, which aligned perfectly well with the previous resistance, now becomes support. Okay, that's the structure level. I told you it worked. Now you're having a very good confluence right now. From that level, you might be looking to take a long. How do you know your take profit level? Just like what I've explained, you would move your Fibonacci to the correction leg. You can see, move it to the correction leg, which is what we have here. And then you now see that the minus 0.272 Fibonacci ratio became your take profit. Have you seen? So after this was the impulse, this was the correction. The next impulse was the next Fibonacci ratio level. That is how to use the Fibonacci. Please, if you haven't subscribed to this channel, please do so, as that will help us create more educational video like this for all of you. Okay, so and if you like the video, and leave in the comment section the next video you would like to see. If you have any question as well, you can leave it in the comment section. They will be answered immediately they are seen. All right, so that is all for the Fibonacci. That's how to use the Fibonacci with the market. All right. See you in the next video.